In this lecture example, we're looking at the right of use of a motor vehicle. Again, this is also quite often just called a company car. And remember, important, a company car is different from a travel allowance. When you have a company car, your employer gives you an actual vehicle to use. When they give you a travel allowance, they give you cash to pay for your travel. Okay, they are treated very differently. Don't confuse the two. I'm not going to go into all the detail here. You've got a very detailed lecture. We'll just quickly talk about some of the concepts in these lecture examples. So in the first lecture example you see here, they talk about Mr. A is employed by X Limited. He receives a company car from the first day of the current year. The employer had purchased it for a cost of $350,000 including VAT. We always use the amount including VAT, and it did not have a maintenance plan. Then I ask you, required, calculate the cash equivalent of the company car fringe benefit. If X Limited had purchased the car on the 1st of March 20X5 and given it to Mr. A to use on the 1st of March 20X5. Now what they're trying to show you here is that you remember that to calculate a company car fringe benefit in its simplest form, we say it is the determined value of the vehicle times 3.5% or 3.25%. That's if there's a maintenance plan, and 3.5 if there's no maintenance. And you multiply it by the number of months. Again, guys, remember, if it's 8 months, you say times 8. You do not say times 8 over 12. That's wrong. You multiply it by the number of months. Okay, now, this determined vehicle value over here is usually the cost of the employer. However, there are certain rules around it. So, in this case, if the employer purchased on the 1st of March and they gave it to the employee on the 1st of March, it means that whatever the employer paid for that vehicle, that is the value of the vehicle that this person gets. So he would use 350,000. There's no maintenance plans. You use 3.5% and you would do it for the number of months. Right, again, remember your tax year starts for an individual 1st of March, runs until the end of Feb. In the second situation, they tell you X Limited purchased a car on the 1st of March 20X3 and they gave it to Mr. A on the 1st of March 20X5. Now, you have to look at how many completed 12-month periods there are between the date when the employer got it and when they gave it to Mr. A. In this case, there are 2 completed 12-month periods, 20X3 to 20X4, 20X4 to 20X5. You don't look at parts of a year. So if it's 28 months, for example, you only look at the completed 12 months, which will be 24. Okay, now, what's the concept here? They tell you, you can't say to Mr. A that Mr. A is getting the value of a vehicle what it cost new. Because he's getting it 2 years later and vehicles lose value, we have to decrease the value of it. And remember, we do that by taking off 15% for each completed 12-month period on the reducing balance method. Reducing balance method means we say cost less the depreciation, basically gives you the amount there, and then that amount less 15% to do it. So you can do it in this way, or you can do it in this way, by multiplying it by 85%. 100% minus 15% is 85%. So by multiplying by 85% for each completed 12-month period. Remember, we do not apportion that's a 12 over 12, and we take into account full 24-month periods. Right, so very simple. The next example. Now, remember, again, like we just saw, you calculate the fringe benefit by saying the determined value times 3.5% or 3.25%, depending if there's a maintenance plan, times the number of months. Right, that gives you an amount. Then, if the employee, the person using the vehicle, kept a logbook, you deduct the business travel percentage. And that will be this amount, let's call it amount A. Amount A times business kilometers over total kilometers. Right, so you are then left here. Let's call this amount B. This amount B over here is basically the private kilometers, the private kilometer portion. You would also be able to get that by saying A, which is that amount over there, times private kilometers over business. Oh, sorry, not over business, over total kilometers. But please, guys, don't take that shortcut. I'm just trying to explain to you it's the private kilometers. Don't do that shortcut. You have to do it in this long way. That's how the act tells you to do it. That's how we do it. So you're left here with the private kilometers. Then, if you incurred costs of license, insurance, maintenance, and fuel, you can claim those costs over here. License, insurance, maintenance, fuel. Only for the ones that the employee paid. If the employee did not pay for license, for example, then you can get license. Okay. All of those costs you'll then take times the private kilometers over the total kilometers. And like I mentioned in the lecture, this is what students mess up all the time. They say that doesn't make sense. It should be the business. You only get deduction for the business travel because that's what you do for travel allowance. No, because you've already deducted everything business here. You get the full advantage here. So this is just additional deductions because they're saying you left here with the private kilometers, the private cost. So if you incur these costs, we'll deduct it from the private use. Okay, so it must be times private over the total. Okay, don't lose a simple mark for that. Fuel is the only one which works a little different. There you must use the deemed cost table that is used for the travel allowance. And you go and look at the cost of the vehicle or the value of the vehicle and you use the correct fuel cost per kilometer and you multiply that by the private kilometers again. And that's it. Remember, if you don't keep a logbook, then everything that we discussed here will not be allowed. If you don't keep a logbook, the full amount as we calculated over there in the beginning, that amount